Welcome everyone to the inaugural Bizval webinar. It's very exciting. I'm the finance ghost, as you've probably worked out by now. And the man you can see on screen is Graham Stephen, one of my co-founders in the business and the CEO. So I think let's get into it. If people join a bit late, it's fine. They will catch up. So here today, we're talking about art, science, ghosts, valuations. These are all very mystical things. And the idea today is to actually just try and demystify some of these concepts, maybe not so much ghosts, because as you can see, my camera is still off. Sorry to disappoint you. And introduce you to the thinking that sits behind the Bizval valuation engine that we've built and we've brought to market and we're very excited about. So I'm sure you know my voice from podcasts at the very least. As mentioned, my ghostliness carries on into Bizval. You're not going to see my face today. Does mean you can look at Graham instead. He's better looking than me. He's the CEO, and he's also a highly experienced chartered accountant. He's seen his fair share of deals in practice, and between him and I, we are 2/3 of the founders of Bizval. Howard Blake is not presenting today, but he's the third founder. Just some quick housekeeping. We will leave time for Q&A at the end of the session, but please feel free to type your questions in the meantime. You're only able to type them. So if you were hoping today was your day to go on stage, that's not going to happen either, unfortunately. The good news is we will be recording this. So if for any reason you have load shedding or you need to drop off or you need to take a call, it will be on YouTube. So don't worry too much about that. Interestingly enough, this is practically a United Nations session. We've got registrations from at least 10 countries the last time we counted, which is quite exciting. So no pressure, Graham, whatsoever. I'll now hand it over to you to talk about the journey of an entrepreneur and particularly why valuations are so important.
Great, thank you, Ghost. Ghost is an expert at doing these webinars. I prefer to build businesses in the back end, but I have to go on stage. So welcome, everyone, and thanks for joining us today. As Ghost mentioned, Bizval is our recently launched online valuation tool. It allows you, the accountant, the entrepreneur, or deal maker to perform a quality valuation for your business quickly and simply without needing to understand any technical jargon. So I'm going to talk quickly a little bit about, why is understanding a business valuation important? I'm going to talk a little bit about the concepts of time and context and how that impacts valuation. And I'm going to hand back to Ghost, who's going to go into a few more of the technical aspects around valuations. I see some people aren't receiving any sound, but I think it might just be one person. If anybody's got issues, just type in the text, please. Okay. Okay, great. Thanks, guys. I think it's just one or two guys who are having some issues. So we've all heard of the concept of start with the end in mind. I know it's very cliched, but as business owners, what does this really mean? For some of us, that might be just running a lifestyle business and working for a salary and the flexibility and the freedom that comes with that. For others, it might be, trying to build a legacy, trying to do something important. For others, it might be building towards an exit or a sale, which can enable a comfortable retirement or a different way of life. But ultimately, most of us have what we call a number. So what is that number? That number is ultimately, it's unique to each of us. But that number is essentially an amount of cash or the financial means to be able to choose to work rather than having to work. And fundamentally, that is why valuations are so important. Because if we want to realize this number, we've got to build something, what we call an asset of value. It's something that has value independent of you, the business person, actually having to do the daily grind. So if you're a business owner, it can't just be about where am I going to find the cash to pay my salaries at the end of the month or chasing the next deal. It's about building an asset of value that can exist separately from you. And largely, businesses only have value if they can exist independently of the owner. If the business is fully dependent on you or the owner, and your capability, once you step out, unfortunately, it's not worth much. So we sometimes refer to this rather morbidly as a hit by the bus test. So what would your business be worth if you weren't around? So we've spoken about the number. Once you understand your number or you know your number and you understand that your business needs to exist independently of you, that's where valuations come in. It allows you to measure where you are currently. You can run scenarios to test, how do you get to your magic number? and then develop plans in order to get there. And as fellow entrepreneurs, we know that it's hard, and that's why we exist. We help you understand the potential of your business and then how to get there. All right. So I spoke and said I'm going to talk a little bit about context and time. Valuations are performed at a point in time. So what something is worth now may not be what it was worth 10 or 20 or 50 years ago. Or conversely, what that might be worth 10 or 20 or 30 years into the future. Things like context change, sentiment changes, market changes, and all these things drive different perceptions and reality of value. So you might ask, why is there a picture of the Eiffel Tower on your screen? Okay. So I thought I'd make it personal. After 2 years of lockdown, my family and I are planning a trip to Paris in September. And for the last 3 months, my 11-year-old daughter has been talking nonstop about the Eiffel Tower. She's researched its history, its story, its beginnings, how tall it is, all of that sort of stuff. So I'm going to use that as an example. So let's postulate for a moment. What was the Eiffel Tower worth in 1900? Consider that in 1887, it was commissioned by an exhibition and was only meant to stand for 3 years before being dismantled. At that point, what was it worth? Perhaps the cost of the metal and the labor in constructing the tower, perhaps the cost of the scrap metal after being dismantled. It may even have been negative, since the cost of labor to dismantle the tower might have been more than the cost of the metal. But if we fast forward to today, 2022, thankfully the city officials 100 years ago recognized how popular the tower was and chose not to dismantle it. And it's become one of the most iconic structures in the world, drawing millions and millions of visitors a year. So with this context, what is it worth today? You could argue that it's worth the value of the ticket sales, or the future value of the ticket sales, less any operating costs. So in other words, how much profit does it generate now and into the future? But you could take that even a step further and say, what about the value it contributes to Paris as a tourist destination as a whole, or to the contribution to brand France and the supporting tourism economy? I think one thing's for sure, though, we can all agree that the value of the Eiffel Tower now is very different and certainly much higher than it was 130 years ago. And if we ask what has changed over those 130 years, it's really two things. The structure is still the same. It's still in the same place. It's the same height. But the time and the context has changed, as well as the utility experienced by its customers, that being the tourists wanting to experience the romantic charm of the City of Lights. So I'm going to hand back to my more illustrious and famous partner, the finance ghost, to dive a little bit deeper.
Thank you so much, Graham. And we certainly hope you enjoy your trip to France. Graham was feeling the pressure because I think there were a couple of registrations for this webinar from France. So needless to say, he needed to get his Eiffel Tower history correct. We have had a couple of people who seem to be having audio issues. I'm sorry about that. For most people, it seems to be working. So I'm not sure what to suggest outside of just, try and rejoin, failing which, as I said, it will be on YouTube. Obviously, this tech is a little bit out of our hands, this webinar technology. So really hoping it gets sorted for the one or two people who are struggling. Apologies for that. Anyway, moving back to this, what you're seeing on your screen at the moment is some art and some science, or actually some cash, which is the science that we're talking about here. And this webinar was entitled Demystifying the Art and Science of Valuations. And Graham's given you some wonderful context into some of the thinking that goes into valuations. It's not that simple. And of course, if it was, you wouldn't have investment bankers. I'm not sure if that's a good or bad thing. I used to be one, so I won't comment. But you certainly wouldn't have Bizval as a business either, and that would be a bad thing. So let's get the paintbrushes out. Let's get the calculators out, or perhaps even Excel. Calculators are a bit old school, and we like to think we're a bit of a disruptor, so there's nothing old school going on here. This artwork on the left, what is that worth? Well, actually, who knows? I've seen expensive art that looks like Toddler Ghost was set loose with the paintbrushes and a selection of paints while him and my wife weren't looking, and somehow that's worth a fortune. And I've seen magnificent art that looks incredible to me, and yet the price is very low. Now, I clearly know very little about what art is actually worth, other than it depends on the buyer and the seller. Now, you're immediately thinking, well, that's a dumb comment, Ghost, because all valuations depend on the buyer and the seller, and you're not wrong about that. That's why there's an element of art in every single valuation. But here's the thing. A business that generates cash flows actually has objective elements to the valuation, and that's where the science comes in. Whereas an artwork that sits on the wall, it doesn't generate any cash, that's very much subjective. It's a bit like cryptocurrency, dare I say it. Now, of course, there's some science behind valuing artworks, right? There's the credentials of the artist. There's the technical difficulty of the piece. But mostly it's about whether or not someone just likes the thing. But when it comes to businesses, if you were offered a really ugly looking factory and it makes R1 million a year in profits, and you could buy that thing for R500,000, even if it's the ugliest building in Johannesburg, you will still buy it, right? Because you are going to get your money back in around 6 months. So ultimately, cash is king. Cash is also measurable, which is really helpful. We know what it's worth. We can count it. It actually has a right answer. If you sat and you counted, all the cash on the right-hand side there, you would get to a correct answer. So the point in evaluation is there are elements of both. There's elements of trying to get to the right answer, even though there isn't quite a right answer, and there are elements of art. And part of this lies in understanding things like forecasting risk, or what is a reasonable expectation for margin expansion in a business. It comes from years of experience in valuations and in seeing lots of different types of private companies in practice. You almost need a feel for this stuff. You need to know what sort of importance gets placed on measures like succession planning, for example. It's not easy. But the science of evaluation lies in applying the accepted methodologies in the market to the numbers that you can see to arrive at an answer. So, for example, a discounted cash flow methodology that forecasts the cash flows, and there's obviously elements of art in there, but certainly there's a touch of science because there's a lot of thinking and a lot of industry practice around what discount rate will you use in your discounted cash flow to bring those future cash flows back to a number today. And experience has certainly taught me and taught the co-founders in this business, and many of you on this call, I have no doubt, that a number of valuation methods actually never really make it from the textbook or your CFA exam into the real world. They're just too complicated and they actually don't add much value, if you'll pardon the pun. Instead, there are just a few methodologies that can be applied to a wide range of companies. And that's why we could build Bizval and why we're so proud of it, is because it actually combines the art and science of valuations along with our years of experience to try and apply that properly. So let's go back to talking about cash a little bit. Now, if a business generates cash, it has value. If it doesn't generate cash, it doesn't really. End of story. Awkward one for tech startups. But let's have a look at, this little person blowing bubbles. Maybe that could be Toddler Ghost, and curly hair is actually kind of similar. But there's clearly some bubbles on that page. As you can see on this share price chart, everything has been rebased to 100, which allows us to compare it because obviously share prices are very different. So, for example, the orange line is Zoom. Now, this chart doesn't mean that Zoom was trading at $750 per share at the top end. What it means is it was trading at 7.5 times higher than it was at the start of 2020 by the end of 2020. That was when everyone in the world assumed that suddenly we would never see each other again in the flesh. We would only ever use Zoom. Whether you are going on a date or phoning your girlfriend or going out for dinner, you will do it on Zoom. But guess what? That's not true. So all the way down came the share price, and it's now 1.5 times what it was at the start of 2020, which, to be honest, is probably a lot more reasonable. Snapchat is another one, the purple line. That's had some colossal sell-offs as, cash flows have started to come under pressure in the market. I had to include ARK. Those who follow my finance writing will know I couldn't have resisted that. It's an ETF run by a lady called Kathy Wood, and they invest in really exciting, but also very frothily valued tech stocks. And again, what went up has somewhat come down. This is a bit of a tortoise and a hare story. The green line is Berkshire Hathaway, Warren Buffett. And again, it's nothing exciting. It just gets on with it, and it's 30% higher than it was at the start of 2020. Now, the reason I've included this chart is to demonstrate the importance of cash flow in a valuation. Unless interest rates are zero and the Fed's money printer does not stop going, cash flow matters. And that's why much of our valuation methodology is built around that concept. And certainly in practice, in deals we've done, Cash flows are what actually counts. This is not about hopes and dreams. This is revenue growth and margins. And it's also why our online tool actually doesn't work for pre-revenue startups, and we make no claims that it can. This is where venture capitalists tend to invest in an idea and the people sitting behind that idea, and they take a shotgun approach. They invest in 20 companies and they hope like hell that 2 of them will work out. And this is known as power law, which means that basically just a couple of successes, because they are so huge, they actually make up for many, many smaller failures. Now, our tool just doesn't work for businesses that are still just a flow chart on a whiteboard. But once we do have cash flows, the question becomes, how much is each rand, dollar, or pound, or euro, if you've logged in from France, actually worth? Some companies will trade on an earnings multiple of 5 times, which means each rand of net profit is worth 5 rand to a prospective buyer. Others will trade on an earnings multiple of 30 times, which clearly makes an enormous difference. If you sold that business, it means you're getting 6 times more money if you can sell it at that multiple. Now, that's going to make a pretty big difference to your retirement, I think. There are a lot of factors that impact the valuation multiple, and ultimately it just comes down to risk. At the end of the day, you are far more willing to pay more for each unit of profit if you have greater confidence in those future cash flows. That's all it comes down to. So this risk assessment is what leads to things like what multiple you pay or what discount rate you use. And in our tool, we've included questions that do this risk assessment, stuff like the size of the business, the company's history, what sector it's in, what country it's in. We think about things like level of competition in a particular industry. Now, there's always forecasting risk as well, because as anyone who has done this in practice is aware and normally has been learned the hard way, everything can look great on a spreadsheet, but it does not always work in the real world. So many, many entrepreneurs, when they try and sell their business, they have this magnificent hockey stick. I know the last 2 years were terrible, but don't worry, guys. I have this amazing plan, and by the end of next year, earnings will be 3 times what they are today. We've seen that 100 times. Got to be careful with that stuff. That's where the art and science comes into it. A time value of money is another critical point. 100 Rand today is worth a lot more than 100 Rand in 5 years' time. And that difference becomes even more important when interest rates are high, and so is inflation. Now, these macroeconomic concepts are completely out of our control, but they have a really big impact on valuations. Low interest rates create these everything bubbles, like you're seeing on the screen here, and high rates have a very good way of popping them. And one way to see this impact is in the number of IPOs in any given year. An IPO is an initial public offering. It's a company coming to the stock market for the first time to raise capital, is what technically triggers its description as an IPO. And it seems so cruel, right, that these macroeconomic circumstances have such an impact on valuations. But that's life. That's how it works. That's how it works even for listed companies. So just have a look at this chart. Look at that cycle. You can see how 2014 was a peak. And by 2016, IPOs in the US, I mean, it's running at less than half of what it was in 2014. Then it starts to come up again. Then we had the pandemic. Then in 2021, we suddenly had this super red hot market being pumped by retail investors. The Fed was printing money. Interest rates were non-existent. Money was literally free. And so needless to say, every company that could possibly put a listing together came to market and raised capital, because you want to raise capital when the market is hot. That's the golden rule. And it's not any different for founders in private companies. The macroeconomics matter. You can have the best business in the world, but if you try and sell it in the deepest, darkest depths of a recession, the pricing is not going to be as good as if you try and sell it at the top of a bull market. So obviously in our modeling, in the methodologies we use, macroeconomics come through in the discount rate, for example, and everything else. And entrepreneurs would do really well to understand those cycles and to plan accordingly. And before I finish off with this slide, I just want to make one more point, which is scenario planning is a really, really useful thing to do with valuations. And by tweaking the inputs, you actually get to see what impact they have on the value. So we're running a promotion at the moment. If you try the Bizval tool out in August, you go on, you buy yourself a voucher, you go and run your business, run it through the numbers. We'll give you some vouchers to go and run a few more valuations. So what that lets you do is it says, okay, let me dream a little. Let's pretend my revenue was 20% higher and my costs were only 5% higher. What would that do to my valuation? Because that's the real power of this stuff, is scenario planning and goal setting. So before I hand back to Graham, and I want to just draw your attention to this Einstein quote, and Einstein's probably the most overquoted person after Nelson Mandela, but there are reasons for these things. And he said, genius is making complex ideas simple, not making simple ideas complex. And that's certainly what we believe we've done in Bizval, and we hope you would agree if you go through and use the tool and try it out. But I want to leave you with a few key points. The first one is there is no right answer in evaluation. It doesn't exist. No one knows exactly what it is, right? It's an art and a science. But there's a reasonable range of outcomes, and that frames a negotiation when you are buying or selling a business. Back to the art and science point, this is not something you can learn out of a textbook. You cannot go and watch a YouTube video that shows you how to do a DCF and you go in and do it and you feel like you've gotten the right answer. I assure you, not because you're not capable of doing that, but because you need to see the stuff in practice. It's really, really important. The third point is our tool has done a really good job of creating a simple user interface in the front, but it feeds a pretty advanced model in the back end. It uses all the same principles that I would have used in my investment banking days, like a discounted cash flow methodology, earnings multiple approaches, and the like. And we do, of course, have cases where the tool sometimes gives an outcome that we're not quite happy with. It is early days for everyone involved, but we are actively doing quality control on every single valuation that gets done. And if we see an answer come through that looks a little bit funny, we jump on it, we engage with the user, we try and understand what's happened. Sometimes it's just an input error or issue that just needs to be tweaked just to actually reflect the reality of what's going on in the business. Sometimes it's something else. It's an adjustment that we think was maybe too hot or not quite enough. And then we'll have that discussion and look to come out with what we believe at least is the closest thing possible to the right answer. And that is because ultimately we are founders, just like you are. Speaking of being a founder, if you could just before the end of our session today, there's a poll where we actually ask you, are you a founder of a business? I think if you just look on the right-hand side of your screen next to chat, you'll see something that says polls. And I think as a guest on the webinar, you can answer it there. And the three options are yes, the hustle is real, not yet, but I'm working on it, or no, not at this stage. Graham, I'll hand it back to you.
Great. Thanks, Ghost. Hopefully you guys learned something out of those insights. And before we move on to the Q&A session, I'd just like to wrap up. And given that this is a webinar, I've got to do the sort of final sales pitch, I guess, as the sponsors and the presenters of this. And for those of you who might have come across Bizval for the first time in signing up for this webinar, I just want to kind of equate what Bizval is. We've had a lot of questions like, what do you do? How are you different to other valuation tools? I think the easiest way to describe that is just to use a quick analogy. I think our South African audience will clearly understand this, but for our international audience, Bizval is to valuations as to what such a thing as a discovery health check or health screening is, as opposed to going to a physician for a full physical MRI scans, all of that sort of thing. Essentially, what we do is we take a few fundamental and key variables. It's like a pinprick blood sugar, cholesterol, blood pressure, height, weight, heart rate test. And looking at these things, we're able to get a very good sense of your overall state of health and what steps can be taken to improve it. And also if there's something wrong, whether you need to go and see an expert, whether you need to go see a physician. But 90% of the time, the answers are going to be the same or thereabouts. The big difference is that the one takes 15 minutes and costs you very little to do. The other costs many thousands of rands or dollars or euros, takes lots of time and lots of appointments. So that's basically a wrap from our side. I want to thank everybody for joining us today. We've really enjoyed hosting you. We're going to move on to a Q&A session at the moment. So if you have any questions, it seems like some people are having an issue with my mic, but if you have any questions, please type them in the comments, and I will narrate and Ghost will answer most of the questions. So thanks everyone for joining us. If you're going to stick around for the Q&A, we'll be on for another 10-15 minutes, and the recording will be made available afterwards on YouTube. So yeah, let's get to some of those questions. Okay, I've got a question here from Kim. It says, what are the thoughts on the current market economy for selling off a large shareholding of business? So thankfully I have the Ghost. So Ghost, over to you on that one.
Yeah, thanks, Graham. So what I'll do is, because it seems to be a bit tricky for some people to hear one or both of us, so what I'll do is I'll always repeat the question, just in case people can't hear you for any reason. So the question was, thoughts on the current market and economy for selling off a large shareholding of a business. So timing is everything, right? So it's slightly hard to answer without knowing what the business does, because at the moment, for example, if your business supplies the mining industry, it's a wonderful time to be alive. But if your business is perhaps dealing with, consumer-facing products and might not be fully proven yet, it's maybe not such a great time to be selling a big stake, because obviously we've got a little bit of uncertainty around the health of the South African consumer. We've seen varied results out of the retailers, some good, some, really dicey. So it's a little hard to answer without knowing what sector it's in. But I think there's a lot of truth in that answer anyway, which is it depends. And it's because these cycles often do not affect different sectors in the same way. So sometimes it's a good time to sell in a particular type of business, like tech absolutely peaked in the pandemic, without a doubt. There have been times where you couldn't give a mining services company away. Now we're sitting completely the other way around. So yeah, so it's a very interesting question. And unfortunately, the answer is it depends.
Great, thanks, Ghost. Okay, the next question, and I think we can post this in the chat, is, sorry, I'm navigating this tool here, is could we see an interface of your valuation tool and run through this perhaps? So Ghost, perhaps you can maybe just talk about where they can find that. I'll post in the chat also a link where people can go and see the interface, but maybe Ghost, if you could just describe the Bizval tool quickly.
Yeah, I used to really love eating pizza before my body started to hate me and made it quite hard for me to do so. So I did an example of a pizzeria, and we've got a little YouTube video on the website, which I think is the link that Graham is fishing out as we speak. And it actually shows you from start to finish exactly how the tool works. So it's well worth going and having a look at that. I think it'll show you from start to finish exactly how the thing works. While Graham's doing that, I'm going to let him concentrate on getting out that link. I'm going to just move on to the next question, if that's okay. It's from Philip, and it says, by cash flow, do you mean EBITDA despite the bank account being under pressure due to reinvestment into stock and debtors? Okay, so it's a great question. For those who that just went right over their heads, EBITDA basically means earnings before interest, taxes, depreciation, and amortization. That probably went over your head for the second time. But what it actually means in simple terms, it's operating profit. Particularly cash operating profit is basically what EBITDA is. But it is cash operating profit before you fund your working capital. So obviously if your sales are growing, so is your accounts receivable, right? Unless all your customers are cash on delivery, if you're selling more, you've also got more money owed to you, and that you need to fund that somehow. You also need more stock. And it's something we're seeing at the moment in this inflationary environment is balance sheets are growing. It's why I've been quite bullish on banks this year, is because if balance sheets are growing, people need to fund that. So when we talk about cash flow, yes, we mean EBITDA minus the investment required in stock and debtors, for example. That's part of how you get to free cash flow. The other adjustment made is for capital expenditure, because again, some companies have very hectic capital expenditure requirements. They have big fixed assets that need to get replenished all the time, and you need to take that into account, which is why we like the discounted cash flow methodology. I'll just jump into the next one, Graham. Let me know when you're done there. Yeah. So I'm going to...
All right, so the next one...
I'll just quickly do Nick's. No, it's fine. Nick's question was, what is the average turnaround time for a typical Bizval valuation? So it's all online. So it really takes you, if you've got your numbers close at hand, and we're not asking you for, what you paid your PA last year in September. We're asking for relatively high-level stuff. It's numbers that you probably know at the tip of your fingers, or you can get quite easily. It'll honestly take you 15 minutes, 15 maximum 20 minutes. And then you've got a valuation in your hands. And then obviously we try and review it like as soon after that as practically possible. And if it does give a funny answer, we've also set some rules that kind of send us an alert to say, unusual results, go and have a look. But you typically get your valuation literally in a matter of 20 minutes. Sorry, Graham, I'll let you...
yeah, thanks, guys. I think just to elaborate on that, as soon as you click compute, your valuation is computed instantly, and we have a back-end review process where obviously we review all those valuations. If there's anything funny that pops up, we'll obviously get in touch with you. The next question is from Kevin. What is the typical discount of a private company versus a listed company?
So that is called a liquidity discount, and the reason it exists is because in a listed company, in theory, you can sell your shares easily. Go and ask people who hold shares in JSE small caps how easy it actually is, and you'll get a different answer while they try and cross a bid-offer spread of 20%. So in practice, what is supposed to happen is listed companies are supposed to trade at a higher multiple than a private company. But I can tell you from experience again, a great private company can absolutely sell at a higher multiple than a smaller listed company. So not the likes of a ShopRite, for example. Obviously, those sort of businesses are always going to trade at higher multiples. But among the smaller companies, it can actually be a smaller difference than you think. But liquidity discounts are somewhere around kind of 20%, give or take. It does vary, but that's a decent rule of thumb, I would think.
Great, thanks, guys. The next question is from Martin. He says his income is from one client only with no contract in place and 80% is personal based. Do you think that sort of company will be worth anything?
Martin, that's a dangerous question. It's like when Mrs. Ghost asks me if I like what she's wearing. I'm gonna take the honest approach with you the same way I do with her, and I might get the same outcome. But no, just kidding. Look, the reality is that unfortunately for founders, and I have the same problem, by the way, in the Finance Ghost. I have this exact issue. What happens if I get hit by a bus tomorrow? There's no value, right? Because there's no ghost. Well, there is a ghost then, but it's not one who can actually do any work. So the challenge is that with only one client, with no contract in place and 80% personal based, unfortunately at the moment, what you have is self-employment, which there's nothing wrong with, by the way. The way to make it a business is obviously to bring in more clients. Make sure you get contracts in place, find ways to scale and get other people into the business to take some of it over from you. And then you can start to actually build something that has value in the equity as opposed to self-employment.
Thank you, Ghost. There's another question here from Ajith. It says, who are you targeting with this tool? Business owners or financiers, etc.?
So I'll answer a little bit, Graham. You're welcome to add to it. I mean, we're definitely targeting, I suppose, first and foremost founders, because it's aimed at private companies. This is not a tool where if you are thinking of punting at shares in Transaction Capital, you go plug the numbers in and it gives you an answer. I mean, you could, but it's not really what it's for. So it's very much business owners, financiers. But Graham, I think you've been having some pretty interesting conversations with lawyers, for example. It might be worth spending just 30 seconds on that.
Absolutely. Yeah, I think the tool is both for the end user, but also for intermediaries. So whether you're an accounting practice or a law practice, and we're finding a lot of use cases across those sort of domains. So for instance, one of our accounting firms wants to add this on as an add-on to the annual financial statements every year, so they can sit down with their clients and actually discuss growth plans with their clients. We have a law firm that wants to use this for shareholder agreements, for instance, when you need to know what the value is or you bring in a new partner into a business. So I think there's a wide range of applications and we're seeing usage across both. All right, guys, I think there's a few more questions. And the next one is from Justin. It's a technical question. So he says he's in the valuation space. I always hear cash flow, cash is king, but how does this work in valuations? Would that be using discounted cash flow and adjusting for non-cash items?
So that's exactly it. So in the discounted cash flow methodology, it's all about getting to the cash number, but we also do use an earnings multiple methodology, and we even use a net asset value methodology as well, and we put different weightings on each one. So we use a multi-methodology approach, which is how it typically works in practice, certainly from what I've seen as well. But the DCF for me is kin as well. I just think it takes the most into account about the business in terms of working capital, CapEx, all that kind of stuff.
Great. We've got a comment here from Tim, and I think I'll handle this. He says, will your app be able to provide an independent value from a buyer perspective? And Ghost, you might want to add to this, but essentially, as Ghost said earlier, we've got a couple of different methodologies we apply. So it can be used by both buyers and sellers. And typically, Ghost, if you want to jump in here, you have an earnings multiple and a discounted cash flow basis. And typically the one is more focused towards the buyer and the other is more focused towards the seller. So Ghost, maybe you want to just add to that.
Yeah, so that's a really good point. So if you're buying control of a business, you've got control over the cash flow. So discounted cash flow is often more important. If you're buying a very small minority stake in a private company, my first point is be careful. That often doesn't end well. But assuming you still want to go ahead, you actually need to value the dividends because that's actually what you'll be getting. So that's a little bit different. If that's something that someone is looking at, pop us a mail. It would be interesting to chat, actually. Our model currently doesn't ask you whether you're planning to buy control or not. So maybe that's something for the future. Again, we definitely know that we're going to be improving this thing over time and coming up with new uses for it. But to answer your question, yes, a buyer could very easily take the numbers on a prospective investment, plug it in, and see what it spits out.
Great, thanks. Gareth has a question, and he says valuation of a private company founded in South Africa, but now operating with shareholding in the United States. So I guess the question is how would you value that?
Yeah, it's a good question. So our model asks you where your primary operations are. So if you're a South African business, just because you've got a US offshore footprint, you're still going to get valued mostly like a South African company. Unfortunately, I know, bad news. That's why certain companies will actually go way out of their way to re-domicile overseas when they get big, is because then they actually start to attract valuation multiples that apply to those markets. So the way that would work is your US income would certainly be considered, but generally speaking, people are going to treat it as coming back to South Africa, and they're going to start to put South African country risk on top of it.
Thanks, Ghost. We have another 4 minutes left in terms of official schedule time, but there's still quite a few questions. So what I suggest is we'll carry on a little bit longer. If any of you need to drop off, please remember this session is recorded. But yeah, we'll carry on probably for another 10 minutes or so answering questions. And any of the other questions, what we'll do is we'll put together a link with some Q&A and post it on our socials. I think the next question, Ghost, is probably more directed towards the Purple Clairvoyant rather than the Purple Ghost. Are we going to see a very acquisition market for the next 5 or so years, a very active acquisition market for the next 5 or so years?
Yeah, look, volatility always drives corporate activity because you have businesses that have got nice, juicy balance sheets, and when everything falls over, they are there to pick up the pieces of, unfortunately, broken dreams and mop that up at a great price. So what drives a dead acquisition market is when people are sitting on their hands because they just don't know what's going to happen. One of the worst professional memories for me was around the time of Marikana, that terrible shootings in South Africa that we all remember. The aftermath of that, no one knew what was going to happen in this place. And people just stopped. They just stopped raising money, stopped doing deals, stopped looking to buy stuff. It was just about squirreling money overseas, following Magnus on Twitter. And that was the vibe. So I think at the moment, South Africa is looking a lot more settled. So I would expect to see no shortage of corporate activity going forward.
Great. There's a question from Lesego, and it says, I'm struggling with the inclusion of LMB, I'm assuming land and buildings. And how do you take this into consideration when you're valuing a business? Particularly when not exclusive or specific to the business.
Well done. I was reading that question and could not figure out what LNB was. I think you've nailed it. So that's exactly what must be the point. There's land and buildings. So the way we take that into account, so founders make this mistake all the time. They own the building, and as a result, the business doesn't pay rent. So they want to be paid based on higher earnings in the business, but they also want to be paid for the property, which is actually double dipping. So what we do in the model is we actually ask you this question. Do you own the property that you currently operate from? And we also ask you, if you were to charge someone rent to take it from you, what would you charge them? So what we do is we value the operations based on paying rent. And then if you own the property, we then just add that back at the end based on what the market value of the property actually is.
Great. The next question I'm going to say is from Anonymous, because we probably shouldn't endorse this. How do you handle the cash element of sales that is not always banked?
We don't. We assume that when you give us your income, it includes everything. We won't comment on whether or not you bank it, or heaven knows whether or not you do other things with it. But the point is you would basically just give us your total income number, and we would work with that.
Great. There's a question here from Nick. He's got two things. Is there a dealer broker account where one might do 10 or 15 valuations per month? And second part is, how many valuations has Bizval done so far? So Nick, I think I'll answer that one. Yes, we do have a mechanism for people who want to purchase multiple valuations. So I recommend that you drop us an email. So we can obviously purchase valuations directly off the website. Or if you're going to be a frequent user, we can do a different post-paid mechanism. I think the second question, how many valuations has Bizval done so far? We officially launched on the 1st of July. Obviously, before that, we did hundreds of tests and validation. But since launch, we've done about 120 in the last, in the last month and a half. We've probably done about 100 to 120 different valuations. So yeah, hopefully that answers the question. Ghost, I don't know if you want to chime in there at all.
Yeah, there's been a lot of testing field work. We really tried very hard to, run it through all sorts of different businesses. I actually saw a question come through. If you don't mind, Graham, I'll just jump to because it's linked. And it was like, what sort of success record do you have? For example, Bizval valued a business at 150. It sold for 145. So I'll give a couple of cool examples. So I've tested it with a couple of friends who have businesses, and they've either had offers on the table or they've got a very good sense of what they think it's worth. And then we run it through and we get really close. And I think what's also important is our co-founder, and I think this is part of why he's also excited about the business. I think he has started more than 20 businesses in his lifetime and has paid some pretty hefty professional fees to get valuations. And when we ran his numbers through Bizval that had previously incurred fees of R500,000 to get a valuation, I think Bizval was within about 5%, Graham, of the answer.
Correct.
So, that's on a cost base of a Bizval valuation is like, less than $2,500, and you're getting to within 5% of the answer. So Graham made the point in the formal presentation around, if you're sick, yes, at some point you need to go to a specialist. We're not that. But what we are is the health check, and a really good one that'll give you a solid valuation range and save a ton of money along the way. It's just really a great sanity check. And it's a good way to actually bring the skill set to founders who may otherwise have no chance of affording it, because it does technically get very expensive in practice.
Cool. Ghost, there's a question here on goodwill. How do you think about goodwill in a small professional business like a medical practice?
Yeah, goodwill is another interesting one. So the technical accounting definition of goodwill is it's the value of everything that isn't measurable as an asset. Sure, my old varsity accounting lecturers wouldn't be happy with that answer, but it's not far off from the truth. And basically what goodwill is, it's your brand, it's how long you've been around, how many people know that you're the practice on the corner. My view on these things is goodwill should be coming through in your cash flows, otherwise it's not goodwill. And that's just the truth of it. If the practice is that valuable, then it will be there in the numbers. And founders, again, sometimes don't like, there's sometimes some ugly truths in this process, actually, which often is more valuable than actually just getting the answer. Because unfortunately, we all do this as founders, because we work so hard at what we're building. We tend to convince ourselves that it's potentially actually worth more than it is. So stuff like, I don't want to sell for this price because you haven't taken into account goodwill. But goodwill is an airy-fairy. It's even more airy-fairy than a ghost. It really is a case of, if the business has got that level of goodwill, we'll see it in the numbers, and those numbers will get fed into the model. And all that goodwill is kind of the assets you can't see. Why is this practice better than everyone else? Why does it make so much money? It's not because it has a great reception desk. It's because it has a great brand, and that comes through in the numbers.
Great. There's an interesting question from Petrus. He says, is it wise for owners to know the valuation of their business once every few years if they intend to sell their business one day?
Graham, I don't know if you want to take that one, actually. I mean, it absolutely is wise, but I know you'll have some views on that.
Yeah, so I think for us, part of this is about building a scorecard. If you want to know where you're going, you need to measure it every now and again. So we firmly believe that this is something, as a business owner, you should be doing, maybe not even once every 3 years, but perhaps once a year. Has the fruits of your efforts in the last year actually made any difference to your assets? To use an analogy, if you build a expensive house in a poor area, unfortunately, there's a thing called overcapitalizing. It's the same with businesses. So you want to be able to check and see, is all the hard work and the effort that you're putting in place actually making a difference to the value of the business? So I think it's important that you do that on a fairly frequent basis. I think,
Graham, if you don't mind, there were a couple of questions further up, and I just don't want to let them go unanswered. And there's some quick ones to answer. So
yeah,
if it's okay with you, I'll just shotgun them. So the first one is, do I think relative valuation tools like EV over EBITDA multiples are valid? They absolutely are. We use earnings multiples in our methodology. People use them in practice all the time. And in doing so, what you need is a feel for the types of returns people are looking for. So, for example, an EBITDA or operating profit multiple of, let's call it 5, if you invert that, you get an earnings yield. So what you get is an operating profit yield of 20%. So that means if you pay 5, you need to be happy that if this company never grows again, your return based on the risk is 20%. So we do absolutely take these multiples into account in our valuation. There's also a question around, how does the valuation tool incorporate macroeconomic indicators? So that comes through in the discount rate, for example. That's why we ask you where the business has its primary operations. This is stuff like the risk-free rate in South Africa is very different to in the US. US treasuries, people panic because they almost hit 3%, or I think they went slightly over. In SA, our long bond rate is kind of 8.5, 9, sometimes 10. So, that's the risk-free rate, and equities need to give you a premium over and above that. So if you build a business in South Africa, the discount rate that gets applied to you is definitely going to be higher than it will be in the US, which is why we tend to have higher valuations in the US as opposed to in South Africa. There was also a question around, will this valuation tool work for a holding company that has lots of businesses in different sectors? Yes, it would, but not once. So what you'd have to do is you'd have to do a valuation for each one and then add it all together. It'll still cost you probably 10% of what a professional services firm would charge you, if that. But you would have to do it separately because each of those businesses, it's called a sum of the parts valuation, actually has a completely different value. There was also a question around a pure services business. How do you handle a law firm, a consulting firm that relies on goodwill and the skills of the directors involved? So it is always very tricky, but there's a question in there which I think is super important, and that is, what would you pay the CEO of this business? Now, you can kind of joke it a bit. If you've got 5 key people, just add them all together and put that number in there. But the point is, a business has value provided it's making more than it would need to pay the people involved. So, for example, in the finance ghost, could you replace me? Yes, I'm sure you could. What would you need to pay that person? That's the question. If the business makes more than that, then it has value. If it makes less than that, then it's sub-economic, and I'm still putting in sweat equity to build this thing. So that question helps deal with that sort of reliance on skills. Almost everyone in the world is replaceable. Sounds horrible, I know, at a price. So as long as you've taken that price into account, you can kind of, look at what that valuation might look like. Sorry, Graham, I've got a couple more here, and then I think we've gotten through all of them in the end.
Yep.
There's a question here, how do we choose a WACC for our DCFs? So again, lots of acronyms there. So WACC is weighted average cost of capital. DCFs is discounted cash flow. So the way we do it, to keep it simple, we are not asking founders what their target debt equity ratio looks like, because it will just confuse people left and right. And to go and then forecast the balance sheet based on what might happen to debt levels, et cetera, is just too hard. So same approach I used to take in practice with this is actually just value the business on a debt-free basis effectively. Like, what sort of cash flows are the operations actually spitting out? Then discount that at an appropriate equity discount rate. What return do I want from those assets? If it's a private company, I might want 20%. Then that's the discount rate. And then at the end, what you do is you subtract the debt to basically say, okay, cool. Once that's done, the business is worth 20 million rand, but it's got debt of 2. So today, the equity is actually worth 18. That's effectively the approach we've taken. There was also the question around price point per valuation. Go check out bizval.co. You'll go see the pricing. It's indicated there in dollars on the site. So for one valuation, it's $130. If you want between 2 and 5, it's $120. And if you are potentially an enterprise customer, if you're an audit firm or a law firm or a business advisor, financial advisor, get hold of us. We can definitely chat about that.
Guys, I think there's one more question.
I think that's it.
There's one more question there around due diligence challenges. So I think that's just an important point. If somebody's buying or selling a business, this doesn't replace due diligence. That still needs to take place, but maybe just elaborate a bit on that for us, Chris.
Yeah, so it's a really good question. It's a nice practical question. Honestly, I wouldn't know how to take that into account in a standard model, because every due diligence is going to be different and unique, right? If you're buying a business in a remote city in Africa, the due diligence looks very different to buying a services company in Sandton. So I think a lot of that comes through in the sort of sector and the way the thing is operating in terms of pricing. But the unique due diligence challenges, I don't think that's something that can really be taken into account in the valuation. The whole point of a due diligence is to go and vet those numbers. And if they can't be, if they're found to be wanting, then you would go and adjust the valuation to say, okay, I don't believe the number's $1 million. I think it's 800K. Go redo the valuation and come out with that.
Great. Well, guys, thanks for all those insightful answers. And to all our listeners, thank you very much for joining us. We will be having a follow-up webinar in the next few weeks or month. And the next topic is going to be how to make your business more valuable. So be on the lookout for that. If you've accepted marketing from us on your registration for this, you automatically get an invite for the next webinar. If not, check out our socials, check out our LinkedIn page, and we'll be communicating that there. So from my side, thank you very much. Ghost, I don't know if you've got any closing words.
Just from my side, I'm really proud of this, and I'm excited to see people use it. I mean, the whole premise behind the Finance Ghost and everything I do is about taking complicated things and delivering them to people in a way they understand. And it's great to do this with you, Graham, with Howard, who's not, presenting on the call right now. I think we've built something kind of special, and I'm very keen to see it in practice. Very keen to get feedback. We're not here to make a quick buck. We're here to build something of lasting value, like most of the people on this call. So try out the tool. Let us know. If you've received an offer and our answer gets close, tell us. If you've received an offer and it doesn't get close, tell us that too, because I want to understand why. So go out there, have fun with it, use it, and come back to us. That's really what we want.
Great. Thank you very much, everyone.